Beating the market is one of the toughest goals in investing. It requires hours upon hours of research, and sometimes that still isn't enough. Many people think that beating the market is impossible. They'll simply dollar cost average into SPY or QQQ and set it and forget it. And honestly, that strategy works out really well. They'll compound money year after year, decade after decade, and they'll lose very little sleep over it. That strategy will save your hairline and mental health, and the style of investing works for 99% of people. But my goal is not to be like the other 99%. Some of the greatest investors like Warren Buffett, Bill Ackman, and Peter Lynch have made a career off of making superior market returns.
Great investors buy, I start to see similarities. They are always high-quality businesses at a great valuation. They're rarely making gambles or rash decisions, and it seems like every move they're making has a purpose and intent behind it. And I intend to run my portfolio in a similar fashion.
What I have created is a brand new Roth IRA.
And for anyone who doesn't know what a Roth IRA is, no worries. It's simply a type of retirement account. So I can use this to save for my eventual retirement and invest in it to let my investments grow. What makes a Roth ideal for my situation and for young investors in general is that the money that you put in today is taxed at your tax rate today.
So every dollar I invest today is being taxed at my current tax rate. And since I'm a corporate grunt making very little cash right now, my tax rate is low. This is advantageous because if I stay on the right path in life, I should make more money down the line, which means my tax rate will be higher down the line. But my cash has already been taxed when I put it in today. Therefore, when I pull out my cash for retirement, I can pull it out tax-free and avoid paying that higher tax rate I will eventually have to in the future.
And this is what makes Roth IRAs so powerful for us young guns. We can essentially get taxed today when we put our money into the account and let our investments ride tax-free. That way, Uncle Sam won't get his cut when we decide to pull our money out later on in life, and we can keep all those gains. When we invest in a traditional brokerage account, the opposite occurs. The money that we put into this traditional brokerage account goes in untaxed, raw, what you put in as your money. However, when it compounds and grows and you have to eventually sell out of your traditional brokerage account, that then gets taxed at whatever your tax rate is down the line, which is most likely going to be higher than what it is today as you are when you're young.
So that's the major perk of a Roth. However, there's one rule about Roth IRAs that is going to make a huge impact on this series. You are only able to contribute $7,500 a year into it. This is going to force me to be extremely intentional with what I buy and sell.
That $7,500 cap means I'm going to have to be very intentional with what I buy and very careful, as every dollar means a little bit more. I can't just dump $50,000 into a stock and let it ride for that year or the next 3 years and hope I outperform the market. I have to use that $7,500 in the most efficient way possible.
That's one of the quote-unquote advantages of a traditional brokerage. There's no limit to how much you can invest in. Another advantage of a traditional brokerage is you can pull your cash out whenever without a fee. For Roth IRAs, you can't pull your cash out until the age of 59 and a half. If you do, there are severe penalties associated with it.
Those are the rules I'm bound by. I can't contribute more than $7,500 a year, and I have to hold the money in this account until I'm 59 and a half to avoid those penalties. But both rules are ones that I think will make this series really exciting. It'll force me to be intentional with where I'm putting every single dollar, and it will force me to really look at companies that I want to hold for decades at a time. After all, this is a retirement account. I want to hold companies that are going to grow year after year.
The purpose of a Roth is to let your investments compound tax-free. If I'm choosing investments that aren't compounding and are poor companies, then I've destroyed the entire purpose of investing in a Roth. Every investment will have to be scrutinized and evaluated to see if it qualifies to be in my portfolio.
One of the biggest challenges of this series is going to be not getting swept up in the daily news stories of the market. We're going to be in booming market times and market sell-off, and the news is going to fluctuate depending on where we're at. There's also going to be hot stocks that everybody wants to buy, and there's going to be stocks that sell off continuously every day that no one's going to want to touch. I think this is going to be an interesting way for me to kind of document how I think and how my thinking progresses over time.
And through all this noise, I will showcase my portfolio, the good, the bad, and the ugly. I'll give you my commentary every day and voice my opinion on which stocks are ones that I want to own and which aren't. I fully expect pushback and disagreements, but that's not something that bothers me.
As I go along in this journey, I want to build a community that's interactive and shares their opinions. I don't want this to be a one-man show where I make all the decisions or do all the research. I want to bring you guys into the fold and hear what you guys have to say, what stocks you think deserve to be in this portfolio. I value the input from my audience, and I want you guys to be part of what makes this portfolio so successful.
Not every stock is going to be a buy. In fact, many of them won't be. There will be hundreds of stocks analyzed, but at the end of the day, I can only choose a select few to be in my portfolio. And those select few have to be absolute winners.
I think that I subscribe to the belief that many great investors have, buying high quality companies at a great price. I don't want to be reinventing the wheel here. I want to stick to the strategy that has worked over the years and time again has produced superior returns. As long-term investors, we have to find companies that have impenetrable moats. We need to find companies that are able to grow revenues consistently while also expanding their margins and growing their free cash flow.
These are the best of the best, the type of companies that can grow year after year, regardless of whether we are in a recession or a market boom. These companies have pristine financials that improve and compound. High-quality companies are ones that can adapt and have innovative teams that are constantly in pursuit of the next revenue driver.
However, it's not enough to just be a dominant company. I have to be able to buy it at the right price.
I'm looking for stocks that have been unjustly punished due to the news or a misunderstanding. Fear needs to have pushed these high-quality compounders down to absurdly cheap levels.
Valuation of the stock and the quality of the company are going to be two of my prime considerations. One without the other can lead to bad investments. If you buy a high-quality company at absurd valuations, you're going to get burned.
Think of Palantir. The financials posted quarter after quarter by this company are so impressive. Yet if you bought it at $200 a share, then you've gotten burnt.
On the flip side, if you buy a stock that's trading at an absurdly cheap valuation, yet their market share is getting taken and their company's being eroded away, you're going to see that stock sell off more.
I think of the cable companies in the early 2020s when their lunch was actively being taken by streamers like Netflix and Hulu, or even a company like PayPal. Its moat has eroded away as more players have entered into the space, like Apple with Apple Pay. Yet the stock trades at extremely cheap valuations. This is a classic example of a value trap.
So the criteria for buying companies in this portfolio is going to be strict, but I think that's a necessity if you want to try to build a market-beating portfolio. We have to plan and make our moves with purpose. Otherwise, our portfolio will just be in line with the average investor.
So that's my mindset for this portfolio. I wanted to make an introductory video to make the rules and my thoughts very clear before we start on this journey. I'll be posting daily on the market and what occurred, as well as doing stock deep dives on companies I own or are looking to own. I can say my thoughts and what my mindset should be, but the only thing that talks is where I put my money.